Welcome to Talk Tickers, where we cut through the noise of earnings calls to give you the signal. Today, we are doing a deep dive into an absolutely wild one. It's for Hooker Furnishings Corporation, ticker HOFT, their Q3 call on December 11th. Well, it started with a thud and ended with a massive rebound.
It was a real volatility vortex, and for good reason. This was, the quintessential kitchen sink quarter for management. They just decided to throw every piece of bad news, the restructuring, the impairments, all of it, into one single report. So it forced investors to make a choice and make it fast.
Right. Is the real story the shocking headline number?
Or is it the strategic cleanup happening underneath? And our job today is to help you separate those two things.
Okay, so let's start with that initial shock, because if you just glanced at the pre-market headlines, the gap numbers were, frankly, terrifying.
They really were. And the stock opened way down because of it. The top line miss set the stage. Consolidated net sales came in at about $70.7 million.
And the street was looking for what, 85?
$85.5 million. Yeah. So that's a huge miss.
Right.
We're talking 17.3% below expectations. Just a steep revenue challenge.
And then you get to profitability, and the shock just gets deeper. The GAAP EPS, a net loss of negative $1.18 per share.
And remember, the street was already expecting a loss. They'd penciled in negative 15 cents.
So this missed by over $1. That's a total net loss of $21.2 million. You just can't look at that number without flinching.
No, you can't. And that is the headline that caused the panic selling right at the open. But here's where it gets so interesting, and why the stock ended the day in the green. The operational performance, if you strip out all that accounting cleanup, it told a completely different story.
Exactly. A story of resilience. When you look at the adjusted earnings per share, it was positive 0.39 cents.
A huge operational beat. Just think about that. Analysts were modeling a 15-cent loss, and the company delivered a 39-cent profit on an adjusted basis.
That divergence is everything.
It's the whole story. Investors had to look right through that massive accounting loss to see the healthy core business underneath. And, well, by the end of the day, they clearly did.
So let's dig into that. We have to unpack what caused that massive gap between the GAAP loss and the adjusted profit.
It all comes down to one thing: cleaning up the balance sheet. This quarter, the company recorded $22.1 million in what are called non-cash impairment charges.
Okay, so impairment charge is one of those accounting terms. What does it actually mean?
It's basically the company admitting that a past acquisition, a bet they made years ago, isn't worth what they thought it was. It's painful, but it's about reflecting reality.
And the big one here was what, $14.5 million related to the Sunset West brand?
That's right. And management was clear on why. They said the sustained drop in their own stock price during the quarter actually forced their hand. Under U.S. GAAP rules, if your market value falls significantly, you have to reevaluate the value of these intangible assets, like goodwill, on your books.
So this was less about some sudden disaster at Sunset West and more of a required accounting move triggered by the stock price.
Precisely. And the key for you, the listener, is that these are non-cash charges. It doesn't touch their bank account. It doesn't affect their ability to pay bills or fund operations. It's a one-time accounting cleanup.
And if you look past that cleanup, you see the core business is actually getting stronger. Gross margin improved to 25.6%.
Which is remarkable. I mean, in a tough demand environment, to see margins expand like that, that's an 80 basis point improvement from last year.
It suggests they have pricing power and that the cost cutting was already working.
It does. And you see it in the core segments too. Hooker branded sales were actually up 1.1%, and their domestic upholstery business was up 3%.
So the core higher end brands are growing.
Right. That's the signal in all the noise.
Yeah.
That momentum is what validated the whole turnaround story for the investors who bought that morning dip.
Okay, that brings us to the strategic pivot. This is the heart of the bullish case. Management said they've hit over $25 million in annualized cost reductions. They use the phrase permanently reset.
And for a company this size, $25 million in savings is a massive structural change. It means they are fundamentally altering their business model. And the key to doing that is simplification.
Through divestiture. They're selling off the value-priced Pulaski and Samuel Lawrence furniture brands.
This is so important. These were the brands most exposed to the tough economy, the value end of the market. And critically, they also carry the most risk from tariffs and international supply chain issues.
So by getting rid of them, the whole company instantly becomes higher margin and, well, less risky.
Exactly. And the deal itself is smart. They get about $4.8 million in cash.
But the bigger deal maybe is shedding the leases. They get out of about $4.8 million in showroom lease liabilities.
That's a huge win. Getting rid of expensive fixed costs like a high-point showroom lease frees up so much future capital. That money can go straight into growth.
Speaking of growth, they aren't just cutting, they're building. The foundation is the cost reset, but the big growth story is the new licensed Margaritaville collection.
Margaritaville is the new flagship. Management is betting big on it. And they backed it up with a pretty incredible number from the recent market. They said initial purchase commitments were 3 to 4 times the historic levels for any new Hooker product line, ever.
3 to 4 times, that's a headline number.
So what makes it so special? Why isn't it just going to cannibalize their other sales?
It's a lifestyle brand. People aren't just buying furniture, they're buying into the Margaritaville escape. It brings in a totally new customer. Management expects it to be truly incremental growth, and since it's a license, it should have better profit margins too.
And that starts shipping in the second half of next year.
Right. So it's a key driver for fiscal 2027. And they're backing it up operationally. They talked about their Vietnam facility getting fulfillment times down to 6-10 weeks.
Which is crucial for inventory and just keeping customers happy. It is. And they also said that over 40% of their sales are now produced or assembled domestically.
A huge hedge against tariffs and trade wars. It's about building a more predictable, stable business.
And when you remove that kind of volatility, the market is willing to pay a higher multiple for your earnings.
Okay, let's shift to investor context. Liquidity, capital allocation. Despite the GAAP loss, they still have plenty of flexibility. About $64 million in available borrowing capacity.
And the inventory story is really good. They brought it down from $66 million to $52 million. Freeing up over $14 million in work capital is just prudent management.
And then they sent 2 really clear signals about how they're thinking about capital. First, a new $5 million share buyback. That says management thinks the stock is cheap.
It's a confidence signal, but then they made a tough call. They recalibrated the dividend, cutting it by 50% down to $0.46 per share annually.
Never an easy thing to do.
No, but they said it was based on shareholder feedback. It's a trade-off, right? You balance the immediate capital return with the need for flexibility to fund this turnaround.
Of course, the macro environment is still tough. They didn't hide from that. Inflation, housing prices, consumer confidence, it's all still a headwind.
They were realistic, but they framed those pressures as being most acute in the businesses they're now selling. So the argument is they're literally shedding their biggest problems.
And they have green shoots in the businesses they're keeping. Incoming orders for the core brands are up year over year for 2 straight quarters.
That's the foundation for their optimism. An analyst asked about long-term goals, and management said achieving historical operating margins high single digits, maybe close to 10%, is a reasonable expectation once things normalize.
So they're just setting a very clear, ambitious target for the future.
They are.
All right, this deep dive has shown a company taking short-term pain for hopefully a much cleaner future. Let's pivot now to our final segment. This is where we talk about an outrageous but plausible trade idea based on everything we've just discussed.
And the standard disclaimer applies. This is not financial advice. We are not recommending you do anything. This is just a thought experiment to test the company's narrative.
Understood. So given the pivot, the impairments, and Margaritaville, what's the trade?
The trade pitch is long HOFT as the lifestyle arbitrage play.
Okay, unpack that. Lifestyle arbitrage.
The rationale is that the market is still valuing HOFT on its past identity. As a complex, lower margin furniture manufacturer with tariff risk and a messy balance sheet, it gets valued on a volatile, low manufacturing PE multiple.
But they're actively shedding that identity right now.
Exactly. They're transforming into a leaner, design-driven entity centered around a very powerful, high-margin lifestyle license. The arbitrage is capturing the valuation gap as the market stops seeing them as a manufacturer and starts seeing them as a lifestyle brand. Lifestyle brands get much higher, more stable multiples.
And the trigger for that re-rating, what makes the trade work?
The trigger is the clean close of that divestiture, which is supposed to happen mid-December. Once that's done, the story has to change. The focus will shift from historical losses and inventory issues to forward earnings based on a clean, low-cost base and the Margaritaville revenue ramp. It becomes a story about brand monetization, not just making furniture.
To sum up our deep dive then, Hooker Furnishings took its medicine. That huge non-cash loss was the price they paid to clear the decks for a leaner, Margaritaville-fueled strategy.
And the market bought it. That initial gap down was erased because investors looked through the accounting noise and saw the vision. They're betting on the $25 million in savings and the portfolio simplification.
So here's the final provocative thought for you to take away. Management says that $25 million in savings, plus the Margaritaville excitement, will get them to high single-digit operating margins when the market normalizes. But can structural changes in a hot lifestyle brand truly shield a home furnishings company from persistent macro headwinds like high interest rates? The answer really lies in how well they convert those huge Margaritaville orders into actual revenue next year.
Until the next call, keep diving deep.
We'll catch you next time.